Hello, I'm David Frazier, aka the Market Monk, and this is our Market Monk show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to affect the value of your investment portfolio. Well, those of you that watched and listened to the video that I recorded this past Sunday on August 3rd know that I was pretty critical of a lot of so-called financial market experts. Folks that said last week that they thought the employment report was a good report, and they thought that the employment report indicated that the employment situation is improving, as well as folks that commented on the latest GDP report, that is the total output of goods and services in the United States during the 3 months ended June 30th of this year, saying that that was a really good report, and that that report indicated that the pace of economic growth would increase during the second half of this year. I was very critical of those folks and told you that it was a bunch of nonsense, and I stick by that. And I promised that I was going to produce another video this past Monday, which I'm just now completing, or am doing now, because I just now completed all of the research and the creation of numerous charts for that video. I promised to do a video, which I'm doing now, to show you why I was so critical of those folks, and to show you why my research indicates very strongly and very clearly that just the opposite is going to happen, that most of these experts are claiming is going to happen during the months ahead. And that is, my research indicates that economic conditions in the United States are going to worsen a bit. Not that we're going to go into a recession, but that economic conditions are going to worsen, and that the pace of economic growth here in the U.S. is likely to slow through the remainder of this year. And lastly, that stock prices will move sideways at best, with a good chance of falling further during the weeks ahead. So instead of saying more in our introduction, now we're going to go ahead and review several of those charts, and I'll comment on the information that's presented in those charts. Okay, first let's take a look at a chart of real GDP, that is the total output in inflation-adjusted terms that the U.S. produced during the 3 months ended June 30th of this year. And what we see is that although the mass media, including whether it's broadcast TV, folks on radio shows, newspapers, magazines, reported last Wednesday that the United States gross domestic product rose 4% during the second quarter of this year. What many of you probably don't know is that's not what actually happened. Unfortunately, what these folks do, almost all economists and financial market experts and journalists on TV, what they do when they report gross domestic product, and really the change in gross domestic product, is they look at the change in they look at inflation adjusted output of goods and services in the total GDP during the most recent quarter. Then they compare that to the previous quarter. So they subtract the previous quarter from the current quarter to get the change in percentage terms, and then they multiply that change times 4, because there are 4 quarters in any given year, to derive the annualized rate of change in GDP during the most recent quarter. Well, as I think I've commented on before, in my opinion, that's a bunch of nonsense. That makes no sense whatsoever. Why would we take the change in something during a given 3 months versus the prior month and then annualize it, that change, as if it's going, that rate of change for that certain period is going to remain constant over some certain number of periods into the future? Complete nonsense. It should never be looked at in that way. And I don't look at the change in GDP that way. What I do instead, which is the same that I'll do with many economic variables that I review and analyze on a regular basis, I'll look at the actual change in versus the same period a year ago. In other words, I'll look at GDP for the second quarter of this year and then compare that to GDP during the same quarter a year ago. And because there's no reason we should annualize it. Why don't we just look at the actual change versus during the same period a year ago? And that's what I do. And what we see when we look at GDP on that basis, as you can see by this chart, GDP rose very modestly during the second quarter of this year, this area right here, versus the same period a year ago. In fact, GDP was up approximately 2.5% during the second quarter as compared to the same period a year ago. So instead of GDP rising at a fast rate of 4%, it actually rose only 2.5%, a very modest rate. So that's the first thing that you should be aware of. Now, we're already about 6 minutes into this video, and I need to make you aware of something that I should have said from the outgo. This is going to be a rather long video. I'm estimating it's probably going to be at least 30 minutes, if not 40 minutes. So you should make sure that you have that amount of time to watch this video if you're really going to get out of it what I think you need to get out of it. And if you don't have the time now, I would encourage you to stop watching this video right at this moment if you don't have 30 or 40, approximately 40 minutes and wait till you have that time. Okay, let's move forward. So there's GDP for the second quarter of this year, change right here versus the same period a year ago. Been rather flat over the past few years, just volatile sideways, no continuation of an uptrend. Now let's take a look at M2 money velocity. And some of you are very familiar with this statistic, this variable, and some of you have no idea what it means. Well, M2 money velocity is the M2 refers to the M2 money supply, which consists of primarily of savings accounts and bank checking accounts, as well as money, cash and currency in circulation. There are a few other components of M2 also, but it's a broad measure of the amount of money in circulation. And velocity, of course, refers to rate of change. And what we see, if we look at this chart, that the rate of change in money has declined and just fallen at a very fast rate since 2010. And what that is telling us is that M2 velocity, what it really tells us is the speed at which money being spent is turned over. How many times has a certain amount of money been spent during a certain period? And that's a very important variable to be aware of, because when the same amount of money is spent over and over and over, meaning one group of people spend money somewhere, and the place that received that money then spends it, and then wherever they spend it, someone else spent it. Well, the number of times that money is spent is telling us a lot about businesses and households and individuals' confidence in the future direction of the economy. And the reason it's telling us that is, think about this for a moment. Well, if a given amount of money is only spent once, and then say you as an individual went out to a retail store and you bought a product, and then when that company that sold you that product just put it in a bank savings account, they did not invest it or spend it on their own personal pleasures or use it to restock inventories or whatever. They didn't respend a check that you wrote to them. They just put it in a bank savings account. Well, that's telling you that, well, why wouldn't they respend it? Why wouldn't they invest it? Why do they put it inside in savings? Well, they would do so only if they were very concerned about the future direction of the economy and the future direction of their business revenues and earnings. So when we see money velocity continue to fall, and look, I mean, we're at a level that hasn't, lower than's ever been recorded. It's telling us that households, individuals, and businesses are very concerned about the future direction of the economy, and that's why they're managing their money very, very carefully. Well, if M2 money velocity stays at these low levels, and especially if it continues to fall, there's almost no likelihood that we're going to have any problematic inflation rates here in the United States, because you can only have inflation if people, individuals, households, and businesses increase their spending substantially, and therefore businesses realize that demand for the products and services is rising, and so they raise prices. But you can't have that occur when you see people being very, very concerned about and managing their money very, very carefully. And also, there's a very little chance that GDP will increase at a rapid rate if money velocity is declining. Because once again, if people are managing their money very carefully, they're being very careful in what they spend. They're putting most of their money away in the bank, or they're paying off debt. They're not buying new products and services. Well, how is the total output of products and services, its GDP, going to rise if people are managing their money so cautiously? It can't. So any of these folks that said this past week that the GDP report indicated that economic conditions were going to improve and that the pace of economic growth was going to increase during the second half of this year, well, in my opinion, those people need to go back and become much more educated or find another job, because they don't know what they're talking about. So now let's look at some other fundamental economic indicators that have historically been very reliable leading economic indicators. That is, economic variables that change direction, that tend to change direction several months before the overall economy changes direction. And economic variables that change direction, well, I should say, let me put it a different way. Let's leave it at that for now. Economic variables that change direction before, several months before the overall economy changes direction. Well, we'll first look at building permits for housing starts. And in other words, anytime a home builder wants to build a new home, first they need to go out and apply for a building permit to build a home. And what we see here is that building permits for the construction of new homes is moved in somewhat a volatile sideways pattern here for several months now. And during the past 2 months, building permits actually declined versus the same period a year ago. So that's telling us that home builders, they're not overly optimistic about the future direction of the housing market and the economy. Otherwise, they would be applying for more building permits to construct more homes. So that's a negative development. Now let's look at pending home sales. First, let me define this variable, pending home sales. What this is it's signed contracts by prospective home buyers to buy a home, whether it be a recently constructed home or a previously owned home, within the next 2 months. So they're pending home sales. They're expectations of home sales. Contracts have been signed to potentially buy a home within the next 2 months. Keep in mind, those contracts can be canceled at any time. So pending home sales, yeah, it moved up for several months here. And this is one of the reasons that I told subscribers to our newsletters over from, I guess, at least from March through June of this year, my research indicated that the housing market was going to continue to improve, because pending home sales tends to be a leading indicator for both building permits for constructing new homes, as well as the actual construction of new homes and actual sales of homes. It tends to be a good leading indicator for the housing market. But even though it's only 1 month, we saw pending home sales move down last month. Very, very modest. Not, this isn't, this could move right back up next month. But I never look at one economic variable in and of itself. I mean, no one economic variable is going to give us any reliable information regarding where the overall economy is likely headed. So if we looked at this by itself, well, that tells us nothing. But when we take any of these charts of these economic variables that I'm covering in this video, and we put it all together, you'll see that a very clear story is developing regarding where the economy is likely headed over the next several months. So let's now take a look at the employment report from automatic data processing. That is a chart of the employment report for private sector jobs, for the number of non-government jobs that were created in any given month since 2001. And as you can see, and I'm going to back up a bit here before we go into this chart, as you can see in this chart and all of the other charts that I present in this video, the blue line is going to represent a chart of the economic statistic or the financial market indicator, such as the advanced decline line and other statistics that I'll get into in a few minutes. That's what the blue line is going to always represent, the financial market and economic indicator. And the black line will always represent the value of the S&P 500 index. And as you can see, we go back to GDP. When GDP declines, the S&P 500 tends to decline. When GDP rises, S&P 500 tends to rise. So, here we've seen sideways volatility. But this chart here would clearly suggest that stock prices are way overpriced, or that we should just be seeing sideways movement at best in stocks as measured by the S&P 500, not a continued up move. Building permits, same thing. In general, this is a leading economic and stock market indicator. When building permits bottom, well, stock prices bottom approximately, in general, in the housing market overall, about 12 to 18 months later. So this has a very big lead time. So here they bottomed. Stock prices didn't bottom to here. But this was telling you, hey, it's a good time to start considering getting back into stocks. When the building permits peak, it was telling you, okay, you need to start being very cautious, because stocks are probably going to peak about 12 months later. And that's what we saw here. Building permits peak, moved lower. About 12 months later, the S&P 500 peaked and moved lower. Here, the two variables turned at almost exactly the same time. Building permits bottom and the S&P 500 bottom. But now we're seeing this volatile sideways movement. Well, why is the S&P 500 tending to move higher? Not tending, continuing to move higher. It shouldn't be. It should have stopped about here and should be moving sideways at best. Okay. Same with pending home sales. You'll see this in all these charts. There's a high correlation between these variables, and these are leading economic statistics that I'm going over right now, and therefore the variable tends to change direction before the overall economy changes direction, and also tends to change direction before stock prices, as measured by the S&P 500, changes direction. Okay, the ADP employment report. This is really it tends to be more of a coincident economic indicator, but it does have some lead time, which you'll see here. The ADP employment report showed that the creation of jobs other than non-government jobs had peaked back here in around mid-2006, and stock prices measured by the S&P 500 did not peak until October of 2007. Bottomed here at about the same time that the S&P 500 bottomed. But we have a peak way back here, and just moving sideways. The S&P 500 should not be continuing to go up. At best, it should be moving sideways. This is a big warning sign. Okay, and you'll also see I drew this red line because several so-called experts last week said how the employment report was a good one and indicated to them that the employment situation is improving and will continue to improve. Well, this red line, I drew this to show that generally this is an area at approximately 250 to a little over 300,000, well, it's around 300,000 jobs, where historically the number of jobs created in any given month has peaked. And we're a bit lower than that, but there's nothing to suggest that we're going to continue to see the number of jobs created continue to move substantially higher. And I'll give you some more indication of that in just a moment. Then we get the non-farm payroll reports, which I told you this past Sunday. This is not the actual number of jobs that were created last month, but what it actually is the number of jobs created last month, an estimate by the U.S. Department of Labor, and then adjusted for seasonality factors, and then annualized to give an estimate of the number of jobs that will be created throughout the entire year. And we're not seeing, we saw the big job creation back here from early 2009 to early 2010. But, the trend's definitely not higher. It's sideways at best, and we saw it move down a bit last month. Once again, very modest, but, this red line, once again, is a level at which the number of seasonally adjusted jobs annualized in any given month has historically tended to peak. And there's no reason, therefore, to think, well, why should anything be different? Why would we expect job creation now to get substantially stronger, especially when we can take into consideration that the U.S. Congress and the President of this country they're not enacting any legislation to stimulate job growth. They're not doing anything. Okay, then we look in at a leading indicator for the number of jobs that will likely be created in any given month, and that's online postings of online job advertisements is what I should have called it. Well, that's what it's called up here. And to me, this is a no-brainer. First thing a company is going to do before they hire people is they're going to put advertisements out letting the world know that they're looking to hire people. And if a company puts out an increasing number of advertisements letting folks know that they're looking to hire people, well, that's telling us that they actually plan to hire an increased number of workers during the ensuing months. And sure enough, if we look at this chart of online job ads as compared to the S&P 500, we see that, once again, it tends to peak about 4 to 6 months before a peak in the S&P 500, and it tends to, well, here it bottomed a little after the bottom of the S&P 500. But it's a very strong correlation. Here it gave some leading information. Here it was a little bit lagging. But you'll see a very high correlation. And yes, these job ads might shoot up in the next few months, but everything that I'm looking at, which is well over 100 economic variables, and when we take all of those variables into consideration, there's nothing that indicates to me that the employment situation is going to improve going forward, that companies are going to advertise for more hirings. So I think there's a good chance that we might have already seen a peak in online job ads. And if that turns out to be the case, and online jobs ads now were to continue to move lower, well, stock prices are probably going to come down. And the number of non-farm payrolls that are created are probably going to come down. The number of private sector jobs that are created are probably going to come down. And if the employment situation does in fact continue to worsen, and we don't know that it will, I'm just taking everything into consideration and putting, trying to assign probabilities of the likelihood of stocks moving substantially higher, lower, or moving sideways. And the economy the probability of the economy substantially improving, just slugging along, or falling apart. And once again, if taking all the information that I have, I'm only giving you, a very, very small set of charts of economic and financial market indicators that I review and analyze on a regular basis. A very, very small subset of what I look at. So, well, now job ads look as if they might have peaked based on everything else that I do on a regular basis. Then we take it the average work week. I don't have a comparison to the S&P 500 on this one, but historically we go way back to 1969, and we see by this red line once again, that the average work week is a very high level and moved lower last month. And once again, everything that I'm looking at regarding the economy suggests to me that it's going to continue to move up lower. And by the way, even though I did not show a comparison chart to the S&P 500 for this economic variable, it also tends to be very highly correlated with stock prices and the overall economy, which is also true for the number of overtime hours that manufacturing employees work in any given week. Once again, very strong correlation here. See how these charts of overtime hours in the S&P 500, see how they tend to move in the same direction? I mean, here we got sideways flatness, the S&P continued to move higher, but definitely when overtime hours moved lower, the S&P 500 fell. Overtime hours moved lower, S&P 500 fell. Overtime hours moved substantially higher, S&P 500 rose. But now we're seeing consolidation here, and we're getting an indication it's not going to move any higher. So why is the S&P 500 way up here? Shouldn't be up here. S&P 500 should be falling a bit and moving sideways at best. Okay, let's see. Now let's take a look. I don't know why that's there. At manufacturing inventories. That is the inventories of manufactured goods that manufacturers of those goods have on hand to sell to wholesalers and retailers of those goods. I know it's a long statement. They're inventories of manufactured goods held at manufacturing companies. And the reason I'm bringing this chart up is if we go back to the GDP report for the second quarter of this year, and GDP rose 2.5% during the second quarter as compared to the same period a year ago, but rose 1% during the second quarter as compared to the first quarter. Remember, we take that 1% change, multiply it times 4, we get that 4% annualized rate that I'm sure you heard on the financial broadcast TV shows and the newspapers and magazines that you read regarding GDP. They took that 1% change, multiply it times 4 to get 4%, which is just nonsense. But if we actually just take the actual change in GDP versus a year ago, GDP still moved up, but at approximately 2.5%. That relatively much higher quarter to quarter, sequential quarter to quarter to change of 1%. My research showed quite clearly that change, relatively big change, was a result, not almost entirely, but almost half of that change came from inventory replenishment by businesses and manufacturers. Their inventories of products to sell to the public had gotten rather low, and they needed to therefore replenish their inventories. If you're running out of goods to sell, you still have people coming into your stores. Well, you're going to have to replenish your inventories, and that's what we saw here. Inventories several months ago had fallen pretty sharply. So what happened? To manufacturers started producing more goods and stocking their inventories of their goods. So we saw a big increase in inventories through, this is April right here, through April and May. We saw April, May, and June actually. Yeah, April, May, and June. Well, that makes sense now. Yeah, that's the first quarter, because this last movement here is from June to July. This is as of July 31st, from June to July. So actually, here's the 3 months, the same period that GDP rose, ending June 30th. It was due to inventory replenishment. But now that those inventories have been replenished, well, since we're seeing no indication that the economy is likely to continue to increase at a rapid pace, that employment situation's likely, maxed out. It's not going to get any better for many months, and good chance it's going to deteriorate. That the housing market is not going to get any better for several months, and it's a good chance it's going to deteriorate. Well, why would we expect manufacturers to continue to now increase more inventories? Well, they're not. To manufacture more goods and to increase their inventories. They're not going to, and sure enough, they're not. So, GDP is not headed higher during the second half of this year. It's not going to happen. Now we look at durable goods orders. Orders from retailers and wholesalers, from manufacturers of durable goods. That is, goods that last for several years, such as automobiles, consumer electronic devices, household furniture and appliances, business equipment. And we see here that orders for durable goods look as if they peaked approximately, I wish I could see the actual date on this, and I don't have it in front of me, but I think it was about a year ago. This is almost a year ago when it looks like orders for durable goods peaked. And yeah, they moved higher during April and May, but then they fell during June and July. They moved higher during March, April, fell a little bit in May, and rose very modestly in June. But the overall trend here is down. And once again, very strong correlation between durable goods orders and the S&P 500. And if this is trending lower, why would we expect the S&P 500 to continue to move higher? We wouldn't. I'm going to speed up the pace a little bit here because you can go through this on your own time and go as slow as fast as you want by looking at these charts at any time and just going to our website. All of these charts are posted on our website and are updated whenever new data comes available. So we get next non-defense capital goods orders. This is essentially investments, not financial market investments, investments by business enterprises in manufacturing equipment, business equipment, in goods, in products that they use to produce or run their businesses, capital goods. And once again, strong correlation. Yes, we only see a slight trend down here. It could move higher, but historically, capital goods orders, non-defense capital goods orders, were getting rid of military items, as well as actual orders for aircraft, which tend to be very volatile, tend to peak out at this level. Okay, the Chicago Business Barometer Index, which is composed of numerous leading and coincident economic indicators, and I just don't have the time to get into all of the statistics that compose that index, but tends to be a fairly strong correlation, once again, between this Business Barometer Index, down, S&P 500 down, up, S&P 500 Index up, down, so on and so on, and we saw a sharp drop in this Business Barometer Index last month. So why are stocks going to go higher? There's too much of a strong correlation. They're probably coming down. Corporate profits, boy, now we're getting to what really matters. I mean, what stock prices, all stock prices are ultimately determined by the level and direction of corporate profits. I mean, that's a no-brainer. And, this goes back to 1994. And what happens? Corporate profits peak, S&P 500 peaks. Usually several months later, and here we have, a year later, okay? So, you cannot use, once again, just one of these variables in and of itself, or you're never going to get in and out of the stock market at the right time. Here, corporate profits peaked way before the S&P 500 peaked, and bottomed about, oh my gosh, about a year and a half before the S&P 500 bottomed. But here, corporate profits peaked only about 9 months before the peak in the S&P 500. Here they turned it about the same time. It's just another warning sign. We see this huge drop. Now, corporate profits might head back up over the next quarter. I don't know. But if they instead continue to move lower, you can rest assured the stock prices are going to start to fall sharply, at least by the end of this year. I mean, they might trade sideways here for several months now. But if we see corporate profits continue to fall sharply, you can bet pretty confidently, but that by the end of this year, any sideways movement in stocks that we might see over the next several months will come to a quick end and stocks will fall sharply. Now let's get into some non-economic indicators. And sure enough, we're about 35 minutes into this video, a little bit more than that. So we'll try to speed it up here, try to keep it at 45 minutes. Mutual fund flows. That is cash inflows and outflows of stock mutual funds, of all stock mutual funds, whether those are funds that invest in U.S. stocks or funds that invest overseas. Strong correlation, the overall trend here, a lot of volatility, of course, but the overall trend is down. Money's coming out of mutual funds. What's coming out of mutual funds? What are those mutual fund portfolios managers doing? What are they being forced to do? If a lot of money's flowing out of their funds, they got to sell stocks to be able to meet those redemptions. So of course stocks are going to go down when you see a lot of money flow out of mutual funds. See a lot of money start to flow back into mutual funds, into stock mutual funds. Now portfolio managers at those funds have more money with which to put to work in stocks. And sure enough, they go out and they increase their holdings of stocks. And therefore the demand for stocks rises. The demand for stocks rises. Well, what happens to the prices of stocks? Just like any other product. If the demand for any given good or product rises, the quantity demand rises, well, the prices are going to rise. And it's the same with stocks. So cash flows increase, S&P 500 increase. The trend is down again, very volatile, but the overall trend is down. Cash is coming out over time. S&P 500 moves lower. And look what we're seeing here in the past several months. Okay, we're seeing here, this is a zero line. So we're actually seeing up through last month, money was still going into stock mutual funds, but much less for several months in a row. And then last month, it fell below this zero level, meaning money is coming out of stock mutual funds, or was coming out, I should say, during the month of June. Okay, now we're going to look at the trading volume on the New York Stock Exchange relative to the trading volume in the OTC bulletin board market. That is, the trading volume of very risky companies that are very unsound companies. They have financial problems. They're often unable to pay their recurring bills on time. They often have a lot of debt. They're losing money. Very, very risky securities in general trade on the OTC bulletin board. Whereas in general, compared to the stocks, that is in a relative term, stocks that trade on the New York Stock Exchange tend to be much less risky than stocks that trade on the OTC bulletin board. So historically, what we tend to see is very speculative investors. I don't know if you would call them investors. People that participate in the stock market that are willing to take a lot of risk and to put money in these types of risky stocks tend to do so near the bottom of economic downturns. I don't know if you know this, but the U.S. economy, I don't have the exact dates on me. It was late 2002 when the pace of economic growth in the United States bottomed. Probably go back to this first chart, GDP here, and actually, yeah, right around early 2002, early to mid 2002. I don't have the exact figures on me. Excuse me for a moment, please. So, at about that same period, these big-time speculators, who are often very astute, and that's why they're willing to take the risks that they do and putting in these risky types of stocks, because they tend to do a lot of research and they're good at what they're doing. They tend to start increasing their trading of those types of risky stocks at about the same time that their research indicates that the economy is going to improve, that stock prices overall are going to move higher. And therefore, they're at least limiting their risk, even though these types of stocks overall, in general, tend to be very risky. If the overall economic and invested environment is improving, still, they're probably going to have more winning trades than losing trades. And historically, what we see is when these speculators start to increase dramatically their trading in these types of stocks, okay, relative to the volume of trading that occurs on the New York Stock Exchange, meaning we have a much higher trading volume in these types of risky stocks than the trading volume in the New York Stock Exchange stocks. Usually when we see that happen, stock prices in general tend to begin to move higher. But when those folks start to curtail their speculative trading and to reduce that trading, then several months later, we generally see stock prices in general, as measured by the S&P 500, move lower. So here, if we go back here, the S&P 500 peaked only 5 months after the trading volume of OTC bulletin board stocks relative to the trading volume of NYSE stocks peaked. The S&P 500 peaked 5 months after that ratio peaked. Here, I don't remember, I think it was about 13 to 15 months before the S&P 500 peaked. So just again, a warning sign. If we just went by this variable in and of itself, our timing is going to be off. We have to take everything into consideration. But then we move forward here. We see here, this ratio declined only a few months before the S&P 500 declined. And now we're seeing this ratio of risky trading volume to more safe trading volume, more risky stocks to less risky stocks, peaked, when was this? This was only 4 months ago. So we're going back to June, May, April, March, that peaked then. That's why, we just don't know the exact timing here, but this is a big warning sign. These folks are starting, these risk takers have substantially curtailed their trading of these risky types of stocks over the past several months. And that's telling you, these people, they do their homework. That's why they take that risk. They're seeing probably the same types of warning signs that I'm seeing. So just another big warning sign that's a good chance that the S&P 500 is peak. The advanced decline line. You're probably familiar with this. I'm not going to get into it. Number of NYSE stocks that moved higher on any given day. Less the number of NYSE stocks that moved higher. The number that moved higher, less the number that moved lower. And then on a cumulative basis, over the past several years, the cumulative number of stocks that moved higher, less as it moved lower. Looks like it's peaked here. And if you look at this chart closely, you'll see whenever that AD line peaks and moves lower for several months, S&P 500 index tends to move lower. And that's what we're seeing. Same thing for the percentage stocks that are trending above their moving average. You can look at this on your own. But when we see that percentage of stocks go from a sideways movement to a sharp drop, what happens to the S&P 500? Down. Sideways movement to a sharp drop, S&P 500 down. Sideways movement to a sharp drop, S&P 500 is probably going to move lower. The VIX, Volatility Index, moves substantially higher, S&P 500 goes down. Substantially higher, S&P 500 down. Moving substantially higher, S&P 500 is probably going to go lower. Yeah. So, to wrap this all up, one more thing. State Street Index. This is a State Street gathers a lot of data on mutual funds throughout the world, as well as other types of institutional funds, pension funds, for example, and it looks at the way in which those funds have allocated their assets. Are most of those funds assets in growth stocks, cyclical stocks? How are they positioned? And it's referred to as the State Street Investor Confidence Index. It's telling you how confident those institutional investors are about the future direction of stocks. And what do we see here? Been trending lower for several months as institutional investors have become concerned about the future direction of stocks. Oh boy, we got even another one. We're already about 45 minutes into this. This is my personal stock high relative price strength index. You can read here what it's actually, how it's constructed. And moved lower over the past several weeks, held at a key price support level, and might bounce off that level. But I can assure you this, I'm very confident if instead this group of high relative price strength stocks breaks through that price support level and moves lower, you can rest assured that stock prices in general are going to move substantially lower. I'm not saying that's going to happen. These are just warning signs telling you that it's time to become much more cautious about how you're allocating your money in the financial markets. And really, all of these statistics can be wrapped up and looked at simply by looking at my buy-sell index, which is based on or derived from the readings on approximately 25 leading economic indicators, as well as several short-term financial market indicators. And you know, as those of you that are subscribers to our newsletters are well aware, you know, the time on this isn't always perfect. I don't expect it to be, but it's been very, very good over the past, since 1986 when I created the model, and backtested it to 1969 at calling major turning points in the financial markets. Doesn't always get it right. I mean, here, look, we had a sell, and the S&P 500 continued to go up. But here we had a sell. A few months later, the S&P 500 peaked, and it fell sharply. We had a buy. Well, that was a good buy, right near the bottom. Yeah, we got out too early if you followed this, but you still did very, very well. Another buy. Here you got out almost perfectly. In late 2007, and you got back in almost right at the bottom if you followed the readings on this index. And sure enough, we got a sell signal last Thursday on this model, and this model's been reliable, very reliable overall over the past 30 plus years, really going back to 1969. And so you really don't even need to go through all these variables and these statistics. You can just look at our buy-sell index on a regular basis. And you can do one other thing by going just to the home page of our website. You can take a look here, which is always on the home page, and it'll tell you what our research indicates overall regarding the investment environment, approximately 2 to 6 weeks into the future, which is currently negative, and 6 and sometimes up to 18 months in the future, which is currently negative. And if you click on the link, there's a link for that information. You'll be able to read a few comments regarding why I'm showing that the environment is negative. Same here, the fundamental environment, I'm showing it's turned negative. You click on the link that's provided, you can see why I'm seeing that. Same with the technical indicators. Here's the IE scale, the investment environment scale. If it's above 5, that's good, it's positive. If it's below 5, that's negative, suggesting stocks are going to move lower. And wrapping it up, we're about 50 minutes into this. I told you it's going to be a long video. I estimated around 40, so we're going to be about 10 minutes over that. All of these charts that I just showed you, well, I shouldn't say that, not all, but the vast majority of these charts are presented on our website. You can look at them at any time. We update them whenever new data comes available, whether it's our market timing, our broad market timing charts, which consist of our buy-sell index, that is this index right here, or our sector rotation indicators, or our short-term overbought, oversold indicators, or our relative price strength index, all under the market timing menu item. The leading leading coincident and lagging economic indicators are all, you can get charts of all those indicators by clicking here on this indicators, looking at the drop downs, as well as mutual fund flows, the value of the US dollar, commodity prices, various other statistics. So, okay, that's a long video. Hopefully you got something out of it. You know, I mean, there's a lot of folks that have told me in the past, I should say, actually, I've never had investors tell me what I'm about to tell you. I've had a lot of people that consider themselves to be marketing people, that is promotional people, tell me that, well, a lot of what I do is really dry. Really, it's really dry. It's not entertaining. Well, do you want to be entertained? Is that what you're looking for if you have money in the financial markets? What would you rather do? Would you rather be entertained and lose a lot of money, or would you read something that's rather dry and feel really very well informed and confident in the way that you should allocate your financial market assets? Which would you rather do? It would seem to me, if you're an actual, serious, real investor, not just someone that's playing around, and not someone that's just divvying in the stock market, but is very serious about your financial market investments, it seems to me you want the type of information that I just went over. So if you disagree with that, please let me know. But on the other hand, if you got some value out of this, also please let me know. I'd like to hear from you. So, okay, that's it. We only do these types of videos from time to time, only a few times a year. But if you're not a subscriber to any of our newsletters and you'd like to get very similar information on a regular basis through our weekly market commentaries and portfolio reviews, as well as our quarterly investment reviews and forecasts, try one of our newsletters. You can do so by going to our website, clicking on the financial newsletters button, and selecting the newsletter that seems to be best suited for your needs. And you can subscribe to any of those newsletters for a period of 2 months at absolutely no charge. Or you can go to these general publishing companies and subscribe to their newsletters from folks who apparently have very, very knowledge based on what they say and write, and listen to what they say. Go ahead, go there and be entertained if that's what you're looking for. I think I'll leave it at that. I thank you for listening, and I'll plan to do some more videos here, much shorter, 5 to 10 minute videos on the more current economic, geopolitical developments and developments in the financial markets, as well as videos from time to time on individual stocks. Thank you for listening. Have a good day.